Welcome everyone. If you are new here, I am Noura Mosri, tax strategist, best-selling author, and I've spent over 2 decades helping business owners, high earners, and professionals plan smarter so they save more and stress less. Today, we're talking about some of the biggest changes to retirement accounts coming in 2026 and how those changes could directly affect you, whether you are an employee, a business owner, or someone in between. We will cover what the new limits are, key mistakes people make with the IRA and 401k accounts, what you should do right now to turn this into a tax-saving opportunity. Let's dive in. So first off, the IRS and retirement plan regulators announced inflation-adjusted limits for 2026. Here's the breakdown. The contribution limit for 401k plan, including 403b, 457, and federal thrift savings, goes up from $23,500 in 2025 to $24,500 in 2026. The annual contribution limit for traditional and Roth IRAs increases by $500 only, raising to $7,500 in 2026. Catch-up contributions for age 50 and older for most 401k, 403b plans rise to $8,000. In addition, the special higher catch-up for ages 60 to 63 remains at $11,250 for 2026. Also important, the income phase-out range for making deductible contribution to traditional IRAs or contributing to Roth IRAs have been increased. For example, single filers covered by a workplace retirement plan see the phase-out range move to $81,000 to $91,000 in 2026. What this means in practical terms, you will be able to save more in these tax-favored accounts, and more people will qualify than before. For employees, if you are in a good job with a 401k match, this means you have an extra $1,000 you could be contributing in 2026 compared to last year. That compounding saving can add up for business owners if you run your own retirement plan or contribute for yourself and your team. This extra room gives you a strategic leverage to plan contributions, decide salary versus profit, optimize tax strategies. Bottom line, these are not marginal changes. They are meaningful in the world of retirement planning. But, and this is critical, only if you act before year ends. Now, here is where many people trip up. They see higher limits and think, I'll just save more later. But they miss the big mistakes. Based on a wide separately advisory for retirement specialists, mistake number 1, treating tax-deferred account like tax-free. You contribute, you deduct now, but when you withdraw in retirement, everything is taxed as ordinary income. Mistake 2, not converting to Roth when appropriate, with changing tax brackets and higher limits. Delaying conversion can cost you. Mistake number 3, ignoring phase-out rules and making contributions when you are not eligible, which leads to penalties and extra tax. In short, higher limits are great, but only if you use them correctly. Missteps now can cost you big later. Talk to your financial advisor about that because I am not your financial advisor. What you should do right now. Here's your action plan for the remainder of this year. Review your 2026 strategy now with the new limits. Ask, can you increase your contributions? Should you shift more to tax-favored accounts? Check your eligibility. Are you covered at work? What's your income phase out? Are you in a plan that allows you the full deductions? Use the extra room if the 401k limit rose by $1,000. Aim to capture that. If you are age 50 and older, plan the catch-up contribution. Consider a Roth conversion, especially if you expect tax rates to rise. For business owners, plan salary versus distributions, contributions for yourself and your employees, and consider timing. A contribution made in 2026 counts in 2026, but making decisions now helps. Get professional help. These rules are changing. Claiming you will figure it out later is costing you money. Remember, the difference between planning ahead and reacting late can be tens of thousands of dollars. So to wrap up, the contribution limits for 2026 just got higher. That's a chance to save more, grow more, and pay less taxes if you plan it smart. But bigger limits don't automatically translate into savings. You still need the right strategy, eligibility, and timing. If you run a business or have a retirement plan, don't wait until next year. Start planning today. If you found this helpful, hit the subscribe button, turn on the notifications, and check out the links below for deeper dive into retirement and tax strategy. Thank you for watching. See you later.